In October 1929, while ordinary Americans celebrated what seemed like endless prosperity, a small group of billionaires quietly executed 3 identical trades. 6 weeks later, the stock market crashed 89% and the Great Depression began. In October 1987, while investors believed computer trading had eliminated market risk forever, those same 3 trades appeared again. 24 hours later, the market fell 22.6% in a single day. In 2007 and early 2008, while banks assured everyone that housing prices never fall nationally, the pattern repeated once more. The financial system collapsed within months. Today, in late 2025, Warren Buffett is sitting on $325 billion in cash. Mark Zuckerberg has sold over $13 billion in Meta stock. Jamie Dimon sold JP Morgan shares for the first time in his career as CEO. These moves have led many analysts to point out potential similarities to earlier periods of market stress. It's not just random decisions by nervous investors. Several financial commentators argue that these developments resemble a familiar pattern that has appeared before previous downturns. Not 2 trades, not 5 trades, but a 3-step positioning strategy that some experts believe major investors tend to use when markets appear overextended. The pattern isn't coincidence, it's mathematics. When asset prices reach extreme valuations, when leverage saturates the system, when euphoria blinds the masses, experienced investors often rely on historically proven defensive strategies. They convert massive positions to cash. They establish sophisticated hedging approaches through derivatives. They prepare to buy world-class assets at significant discounts if panic reaches maximum intensity. Most people miss this entirely because they're focused on the wrong signals. They watch earnings reports, Federal Reserve announcements, economic data releases. Meanwhile, portfolio managers and institutional strategists are often watching broader historical cycles and risk management indicators. They're tracking the 3-stage sequence that has appeared in previous bubbles, the kind that includes extreme overvaluation, excessive leverage, a triggering event, forced liquidation, panic selling, and wealth transfer. Not because it guarantees a future outcome, but because it has repeated often enough to shape institutional playbooks. Jesse Livermore understood this better than anyone. Born into poverty in rural Massachusetts, he started as a chalkboard boy, posting stock quotes for $5 per week. But Livermore possessed something most investors lack. He could see patterns that others missed. By age 16, he was trading full-time and earning $200 weekly, a fortune in the 1890s. Livermore's genius wasn't in picking individual stocks. It was in recognizing when the entire system had become unstable. Throughout 1928 and early 1929, he watched margin debt explode to levels never seen before. 300 million shares were being carried on margin by midsummer 1929. Ordinary people were buying stocks with just 10% down, borrowing the remaining 90% from brokers. Taxi drivers were giving stock tips. Shoeshine boys were discussing market strategies. The warning signs were everywhere. So Livermore began executing the first trade. He liquidated his long positions systematically, converting millions to cash. But he didn't stop there. Through the summer of 1929, he established massive short positions using over 100 different stockbrokers to hide his trades from other market participants. This was the second trade, sophisticated hedging that would pay off when prices collapsed. When Black Tuesday arrived on October 29, 1929, Livermore's preparation paid off spectacularly. While ordinary investors watched 16 million shares trade hands and $14 billion in wealth evaporate in a single day, Livermore collected over $100 million in profits. The man who started posting stock quotes for $5 weekly had become one of the wealthiest individuals in America by recognizing and profiting from the historical crash sequence. Bernard Baruch followed the identical pattern. One of the most successful investors of the early 20th century, Baruch had made fortunes in previous panics by recognizing bubbles before they burst. Throughout 1928, he watched stock valuations reach levels that had no basis in economic reality. The price-to-earnings ratio of the Dow Jones Industrial Average hit 33, far above any historical precedent. Baruch executed the same 3 trades as Livermore. He converted massive stock holdings to cash during the first half of 1929. He established short positions betting against overvalued companies. And when the crash destroyed everyone else's wealth, he deployed his cash reserves to buy quality assets at depression prices. This was the implicit fourth trade that follows the initial three. After protecting capital, hedging against collapse, and positioning for volatility, billionaires buy everything valuable when fear reaches its peak. The pattern repeated in 1987, according to traders who studied earlier cycles, but with modern technology amplifying both the build-up and the collapse. Throughout the mid-1980s, stock prices tripled as investors believed computer trading had eliminated market risk. Program trading, portfolio insurance, and index arbitrage were supposed to make crashes impossible. The Dow climbed over 40% just in 1987 alone. Tudor Jones wasn't buying the hype. Along with his chief strategist Peter Baruch, Jones spent months comparing 1987 market patterns to those of 1929. The parallels were what he called spooky similarities, not as a prediction of a guaranteed crash, but as a warning that risk was escalating dramatically. Both periods featured rapid run-ups, driven by optimism rather than fundamentals. Both saw new technologies that supposedly changed everything. Both witnessed extreme valuations that had no historical precedent. Jones began executing the three trades in summer 1987. He raised substantial cash by reducing long positions. He purchased massive put option positions on major stock indices, essentially buying insurance that would pay off if markets fell sharply, and he waited. On October 16, 1987, Jones studied his price charts and told an associate they were about to see something unusual, something not witnessed in decades. Black Monday arrived 3 days later. October 19, 1987, saw the Dow fall 508 points, over 22% in a single session. Record volume of 604 million shares traded, 3 times the daily average. The New York Stock Exchange lost over $500 billion in market capitalization, but Jones's preparation turned catastrophe into triumph. His fund generated returns exceeding 60% for the year, mostly from that single day's trading. The 2008 financial crisis created one of the most dramatic wealth redistributions in modern history, and once again, the same three trades appeared before the collapse. Michael Burry began recognizing the housing bubble's unsustainability as early as 2005. He analyzed mortgage lending standards, regional price appreciation rates, and borrower qualification criteria. What he discovered deeply concerned him. Banks were lending to almost anyone, packaging weak loans into securities, and selling them to pension funds and insurance companies worldwide. Burry executed the first trade by converting his hedge fund from long equity positions to cash. But the housing market didn't offer traditional shorting mechanisms, so he worked with Goldman Sachs and other investment banks to create credit default swaps on mortgage bonds. These were essentially insurance contracts. Burry paid premiums of 2 to 4% annually on the notional amount insured. If the bonds didn't default, he lost the premium. If they defaulted, he collected the full insured amount. From 2005 through 2007, Burry paid these premiums while his investors grew furious. They thought he'd lost his mind as housing prices continued rising. But Burry understood he was executing the second trade, establishing sophisticated hedging positions that would explode in value if the system weakened. John Paulson recognized similar risks nearly a year after Burry, but with far more capital at his disposal. Paulson's funds purchased tens of billions in credit default swaps on mortgage securities. When the housing market finally broke down in 2007 and 2008, these swaps generated what remains one of the largest payouts in hedge fund history. Burry made over $700 million for his fund, with $100 million in personal profit. Paulson collected nearly $20 billion across all his funds, personally earning over $4 billion. Warren Buffett executed the third trade during 2008. While others panicked, he deployed Berkshire Hathaway's cash reserves to buy world-class assets at unprecedented discounts. His $5 billion investment in Goldman Sachs' perpetual preferred shares paid him 10% annually while giving him warrants to buy common stock at deep discounts. This exemplified the billionaire playbook: preserve capital before instability, hedge against potential collapse, then buy high-quality assets at distressed prices when conditions allow. Many modern analysts point out that similar preparatory moves can sometimes be seen in later periods of heightened uncertainty. And today, some argue that a comparable sequence may be forming again. The pattern is now being discussed widely in financial circles in 2025, with many pointing out striking data points. Warren Buffett's $325 billion cash position represents the largest corporate cash hoard in history, both in absolute terms and as a percentage of Berkshire Hathaway's total assets. Some market observers interpret this as a defensive posture rather than ordinary cash management. Throughout 2024 and 2025, Buffett has been selling aggressively. He reduced his Apple position by over 50%, unloading more than $100 billion worth of shares. He has also been trimming Bank of America, even as the stock hit new highs. When asked, Buffett simply said he could not find anything attractively priced in the current market. Many analysts treat this as a signal that valuations may be higher than Berkshire prefers, not necessarily a prediction of a crash, but a reflection of disciplined value investing. The Buffett indicator, which divides total stock market capitalization by gross domestic product, now sits at 217%. Buffett himself has stated that readings above 120% indicate dangerous overvaluation. At 217%, experts note that markets appear far above historical norms. The stock market is now worth more than double the size of the entire American economy. While this does not guarantee a downturn, it places valuations in territory that analysts describe as extremely stretched. Mark Zuckerberg's stock sales tell a similar story through different numbers. The Meta CEO has sold over $13 billion worth of company shares throughout 2024 and 2025. These aren't small position adjustments or routine diversification. According to financial reporters, these sales represent unusually large liquidations during a period of record stock prices. The pattern mirrors insider selling before both 1929 and 2000, when corporate executives reduced exposure during peak valuations. Corporate executives often have insights into long-term revenue pipelines, competitive threats, and operational challenges long before they appear in quarterly reports. Jamie Dimon's stock sale carries even more significance because of its historical uniqueness. The JP Morgan Chase CEO has never sold company shares during his entire tenure as chief executive. His decision to sell in 2025 breaks a pattern maintained for more than 2 decades. Analysts interpret this as an unusual but not necessarily alarming shift, possibly personal financial planning, but notable because of its timing. Across corporate America, insider selling now matches levels not seen since 2007. The top 10 insider sellers moved nearly $4 billion worth of stock during the first quarter of 2025 alone. Oracle CEO Safra Catz sold $705 million in company shares. Amazon founder Jeff Bezos has liquidated over $13 billion in stock throughout the period. While insider selling does not automatically predict a market downturn, the volume has been highlighted by analysts who track market sentiment and executive positioning. Central bank gold purchases reveal the second trade happening at unprecedented scale. In 2022, 2023, and 2024, central banks purchased over 3,000 tons of gold, the highest 3-year total since tracking began in 1950. China has been accumulating aggressively, adding to reserves every month for more than 2 years. Russia continues buying despite sanctions and economic pressure. Turkey, Poland, Singapore, and India are all diversifying away from dollar-denominated assets into physical gold. This is unusual. For decades, central banks sold gold and accumulated dollars and euros. Economists suggest that the reversal reflects concerns about long-term currency stability, global debt levels, and geopolitical risk, not necessarily a prediction of collapse. Gold provides protection against potential currency debasement during periods of economic uncertainty. Ray Dalio has long advocated holding 5 to 10% of portfolios in gold as insurance against monetary instability. Stanley Druckenmiller has disclosed significant gold positions through his family office. Even Paul Tudor Jones, who made his fortune trading stocks and bonds, now discusses gold as a hedge against policy-driven currency erosion. Analysts view these positions as standard risk management strategies for uncertain cycles, not as guaranteed forecasts. The derivatives markets are now revealing what some analysts consider the third trade through credit default swap pricing and options activity. Credit default swaps on commercial mortgage-backed securities have risen sharply, with prices up 300 to 500% since 2021. This represents insurance against potential defaults in commercial real estate, and the cost increases suggest that institutional investors are pricing in higher risk levels across that sector. Commercial real estate faces challenges that many people still underestimate. Office buildings across America sit 40 to 50% vacant due to widespread remote work adoption. These properties were financed when interest rates were around 3%. Now those mortgages are maturing and must be refinanced at 7 to 9%. Buildings that barely cash flowed at 3% interest become extremely difficult to sustain at 8%. The mathematics are simple and unforgiving. Over $2 trillion in commercial mortgages come due through 2025 and 2026. Property owners facing refinancing at triple the interest rate have three choices: inject massive new capital, default, and return the property to the lender, or negotiate modifications that often resemble partial defaults. Analysts warn that many owners may opt for default or restructuring, which could create stress for regional banks carrying these loans. Put option activity on major stock indices offers another layer of the third trade. Institutional investors have been purchasing large blocks of puts expiring in late 2025 and 2026, indicating strategic hedging in case markets weaken. The put-call ratio, which measures bearish versus bullish options activity, has remained above 1 for extended periods. Historically, elevated put-call ratios reflect increased demand for protection, not a guaranteed prediction, but a defensive stance by sophisticated investors. VYX call options reveal another angle. The volatility index spikes during periods of fear, and buying VIX calls is essentially a bet that volatility will rise. Unusual accumulation of VIX calls expiring throughout 2025 suggests that some traders anticipate choppier market conditions ahead. Again, these are hedges, not certainty. Bill Ackman has publicly discussed considering hedges similar to his March 2020 trade, where he converted 27 million into 2.6 billion in a matter of weeks. While he hasn't disclosed specific positions, his commentary suggests that he sees elevated risks, not imminent collapse, but conditions warranting caution. The artificial intelligence boom has created concentration risk that many economists now consider unprecedented. 7 stocks represent approximately 30% of the S&P 500's total market capitalization. Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla have become so large that their individual performance heavily influences the entire market. Nvidia alone illustrates how extended some valuations have become. The company trades at a price-to-earnings ratio above 65, meaning investors pay $65 for every dollar of annual profit. Nvidia's total market value exceeds $3 trillion, making it worth more than the entire German stock market. Analysts emphasize that while Nvidia is a groundbreaking company, valuations at this level bake in enormous expectations that may be difficult to sustain in the short term. Everyone believes AI will change everything, just like everyone believed the internet would revolutionize business in 1999. They were ultimately right about the internet's long-term impact. They were catastrophically wrong about near-term valuations. Some experts caution that a similar dynamic may be unfolding today. Long-run optimism mixed with short-run overpricing. The three trades appear active across multiple asset classes. According to analysts who study historical bubble behavior, billionaires are raising cash at unusually high levels. They're buying gold and establishing derivative hedges. They're preparing to deploy capital if markets experience severe volatility. But it's important to note that these are risk management strategies, not definitive predictions. The sequence that occurred in 1929, 1987, and 2008 is often referenced by financial historians. Each time, major investors executed similar positioning strategies. Each time, there were dramatic asset price declines. Modern commentators highlight the parallels, but also stress that history does not guarantee repetition. Still, some signals today are catching attention. The Buffett indicator above 200%, insider selling near multi-year highs, central banks buying 3,000 tons of gold annually. Analysts view these as noteworthy risk indicators, not forecasts, but signs that large players may be preparing for a range of outcomes. Most people tend to overlook these patterns, just as many did before previous downturns. They trust that rapid technological change, like AI, will transform everything instantly. They assume fiscal and monetary policy will support markets indefinitely. But seasoned investors often plan for uncertainty rather than certainty. A smaller group, however, watches the patterns. They recognize that when experienced investors reposition across multiple asset classes, it often reflects caution rather than panic. They notice that when the most sophisticated capital in the world aligns across similar strategies, it can be interpreted as preparation, not prophecy. The three trades have been observed historically. Whether they will matter in 2025 depends on countless variables, and no outcome is guaranteed. But understanding the pattern helps ordinary investors recognize how major players approach periods of elevated risk. The pattern, according to financial historians and market analysts, is difficult to ignore. The legal framework is established, the enforcement apparatus is operational, global cooperation around digital asset oversight is in place. Many experts argue that the scale of today's financial imbalances resembles past periods of heightened vulnerability, though outcomes can still vary widely. In 1933, Americans who trusted their government saw their gold ownership restricted under emergency economic policy. In 2025, some financial commentators cautiously suggest that digital asset regulations could evolve in unexpected ways during future crises, depending on how policymakers interpret their authorities. The only question, these analysts say, is whether the public recognizes early warning signs or dismisses them as noise. Today, the signals many analysts watch are flashing simultaneously: cash accumulation among large investors, elevated insider selling, significant central bank gold buying, rising hedging activity and derivatives. While none of these indicators guarantee a market downturn, experts often cite them as evidence that sophisticated investors are preparing for a range of possible scenarios, rather than predicting a specific collapse. Yet each cycle, 1929, 1987, 2008, had one thing in common: a subset of experienced investors reduced risk, increased liquidity, and positioned defensively before major volatility. Each time, those who recognized the pattern were able to navigate uncertainty more effectively than the masses. Now, in 2025, the same three strategic principles appear again: preserving liquidity when valuations stretch, using protective hedges when leverage builds, positioning to deploy capital if markets dislocate. Some analysts interpret this alignment as cautionary preparation. Others see it as sophisticated risk management. What's clear is that the most experienced investors aren't acting randomly. They're following playbooks shaped by decades of market history. The mathematics behind bubbles and corrections hasn't changed. When assets disconnect too far from fundamentals, when leverage becomes excessive, when optimism becomes one-sided, markets often rebalance, sometimes gently, sometimes suddenly. No one knows exactly when or how it may happen, but major investors prepare long before the headlines arrive. Most people, however, ignore these signals. They assume this time truly is different. They believe innovations like artificial intelligence guarantee permanent prosperity. They trust that central banks can always control outcomes. Market historians warn that overconfidence has been a defining feature of every major speculative peak in modern finance. But they also emphasize that each era is unique and future results are not predetermined. A much smaller group takes a different approach. They study patterns, they analyze positioning. They recognize that when long-term, experienced capital reallocates in similar ways, it often reflects prudent preparation, not fear-mongering or prophecy. The three trades, raising liquidity, hedging intelligently, and preparing to buy quality assets during dislocations, are not about predicting doom. They are about understanding cycles and managing risk during periods of elevated uncertainty. Whether 2025 becomes another historic cycle or simply a moment of volatility that passes quietly, the principle remains the same. Those who prepare have options. Those who ignore the signals often do not. According to many analysts, the pattern is visible again. What it ultimately means will depend on global events, policy decisions, and market behavior in the months ahead. But one thing is certain: the investors who study history will know how to respond, no matter how the sequence unfolds.